Good morning, good afternoon, or good evening, depending on your perspective on the world. Welcome to Trading Coaches Playbook. My name is Brandon Wendell, and I'll be your host for the next hour or so. As basically, forgot to submit a topic. So, what I'm going to do today is just kind of a market overview and just kind of take a look, see what's going on in the broad markets, and answer any open questions you might have. Sorry, my dog is licking my ankles here, running around where she went. Anyway, so yeah, we'll kind of keep it kind of an open Q&A type thing, but welcome to Trading Coaches Playbook. And just before we get started, I need to remind everybody, we're not broker dealers or investment advisors. So I'm going to look at this information from an educational standpoint, not telling you to buy, sell, or hold any particular securities, to give any personalized recommendations about the markets. All markets do involve risk of loss, and this is always a situation. No matter what we do, we can't eliminate the risk. We just try to minimize it and manage the risk. So don't trade with money you can't afford to lose. And we are not subject to trading restrictions, so we can have positions in a security or initiate one at any time. So there we go. You can stay in touch with us. We're pretty busy here. We got a lot of stuff going on. The programs I primarily work in, I've got something called the E-mini think tank that keeps me pretty busy. You can see Monday, Wednesdays, and Thursdays, we meet in the markets live from 9 a.m. until 11 a.m. As a matter of fact, where's my browser here? Forgot I wanted to log in. Close this out for now. But basically, there's a lot of education there on trading in general, on trading the future specifically. That's really what we focus on in the E-mini think tank, hence the name E-mini. But we basically look at the different ways of trading the markets, the way the professionals trade, and how to basically identify high probability opportunities to mimic what they're doing in their own trading. So if you're interested in joining me, there's a couple different ways of doing it. There's a quarterly subscription and then a monthly subscription. The quarterly subscription is kind of cool because you basically get to try it out for free for 2 weeks and kick the tires, if you will. And basically you get access to everything. There's all this, these recordings and bonus videos that have tons of education, basically shows you how I trade as well. And yeah, it's all in there. And then we meet, like I said, live 3 days a week to exercise what we've learned in the live markets. So I'd love to have you join me in that. If you're interested, let me know. And yeah, I got a few other programs, but for the most part, like I said, I'm really involved in that. You can stay in touch with us through the socials, of course. I'm also on my own socials there as well. So yada, yada, that's it. Okay, so I wanted to jump out and kind of take a look at what's been going on. This is historically, September is not a great month for the markets. When I talk about the equity markets, there's trading opportunities, don't get me wrong, but historically, you don't usually see a really good rate of return during the month of September on the equities. And if I go out to, this is MRCI, I can use a lot of different resources. Actually, you know what? I'm going to use a different one. We have what's called seasonality when it comes to the markets. Everything is seasonal. You go through what's called spring, which is when the beginning of an uptrend starts. Summer is the full-blown uptrend. Autumn is the turn where things are starting to get a little toppy and going down. And then you have winter, which is the full-blown downtrend. So every security goes through those cycles, and they're not lined up with the months. It's not like, oh, September must be autumn. No. Okay, every security has its own individual cycle. And the way you find out these cycles is by basically observing price action over, minimum of 5 years, but usually 10 to 15 years. So for instance, if I want to look at the seasonal pattern, I'll go to an interactive chart here for the S&P 500. Let's type in ESZ23, which is the current contract. And I'll even bring in a little bit more. There we go. So what we're looking at now is in the black, that's the current chart for this year for the S&P December contract. And if I zoom in, you can see we have in red the 5-year average price movement. Then we got 10 years in green and 15 in the blue. So by looking at our chart, you can see that we are pretty much following with the historical pattern. So one of the better times to buy the S&P, for instance, would be in June until the beginning of August. As you can see, over the last 5 years, 15, even 10 years, heck, we can go out to 30 years, actually, if I zoom out of this again. We're looking at long-term historical patterns here. We can zoom in a little differently here. There we go. So as I was saying, if we go back a little bit to right here in June, you can see end of June, Last 30 years has been very, very bullish. Even the last, like I said, 5 or 15 years. I'll get rid of the 10. Just don't want to have too many lines in between there. But basically, our job as traders is to find the highest probability patterns and follow those. So as we're coming forward a little bit more, you can see September. Here we are. So let's look at the month of September as a whole. And historically, what happens during that month? Well, as you can see, mid-September, over the last 30 years, right around the 19th and 20th of September, the markets usually take a little dive into the end of September. In the last 5 years, it's been a more gradual decline, but it's been a decline nonetheless. So historically, if you take a look at the entire year, it's not necessarily the most bearish time of year, but you got a little bit in the spring there in February. But overall, September is not usually a very good month for the equity markets. I know October gets the big rap or the bad rap because that's where all the big crashes happened, right? 1987 and a bunch of others. So, Black Friday, Black Monday, back in 1929, those all happened in October. But for the most part, September's pretty weak for the equity markets. And then we get our Christmas rally going on for the end of the year. So understanding some of those patterns can give us a higher probability of success in identifying where the markets are going to go. And we can see that pattern follows through, I believe. If I go out to the NASDAQ and QZ, same thing. You see the last 5 years been pretty bearish between, well, pretty much now until October 11th. And even the last 15 was bearish. The last 30 is not showing for some reason there. That's weird. Anyway, the Dow, take a look at that. And same thing, you're seeing bearishness during this time of year. So we should expect the markets to be heading a little bit down during this month. And when we take a look at what's going on, big picture, I'll go out to a weekly chart here. This is the ES. And you can see that, we made a peak back in July, dropped down, made a lower high right now. We're not in a downtrend, at least not on the weekly chart, but we are seeing a lot of weakness in the overall trend. We're not able to break out the new highs all of a sudden. We're just kind of hanging out right here and we're losing momentum. Those of you who have been in my classes know that this is the RSI on the bottom. And I use the RSI, which is relative strength index or indicator, whatever you want to call it. But I use it a lot different than the way most people use it. Most people use it as an oscillator indicating overbought and oversold situations. Well, you can use it that way, but it's not going to give you the best signals. Okay, and basically the reason why is it's delayed. Everything's delayed when it comes to technical indicators. So instead, I kind of manipulate this a little differently, and I use it as a momentum indicator. Now, I'm not going to go into all the nuts and bolts of it. Basically, if you're interested in learning more about how I use that, basically, if you go into the bonus videos here, I think I have a video on RSI somewhere. Where is it here? Got tons of videos. There it is. Yeah, relative strength index, RSI, and how I use it. I also actually have documentation. There it is. That supports that, my RSI rules right there, for instance. So I have it all detailed out how I do it in real, big detail there. Oh, you're working with Hekinashi scalping and inner circle with a nice trip. Yes, I do use this on a 14 period or 14 days. In this case, I'm actually on a weekly chart, so 14 weeks. But yeah, the only manipulation I do for the indicator is I change the overbought and oversold. That's pretty much it. So with the momentum indicator, normally oversold is 30, but I use 40. And then overbought, I use 60. It just works better by using those numbers instead of the traditional numbers, as I said. And I do use 14 period, which is usually default of most programs. Sometimes you'll see 21, it's personal preference. The thing with indicators is if you speed up the number of periods, it becomes more sensitive to changes in price, but you are more subject to false signals. So you got to find a happy balance between sensitivity in the indicator, so it gives you good signals, but not false signals. So it's not easy to figure it out, but I just leave it at 14 periods. This worked fine. one of the other things I talk about, and again, if you want to learn this stuff, it's all in that e-mini think tank. You can learn tons of this stuff. It's all there. Trying to remember where, let's see. There we are. Trying to bring something open for you, or open something up, excuse me. File, open. There it is. And as soon as it loads up, there we are. So if you're interested in joining me in the e-mini think tank, I just put it in the chat there for you, the link. So you can go ahead and click on that. And it basically would bring up this page where, like I said, if you want to just try it out, there's no risk because we don't even charge your credit card for the first 2 weeks. So if you do the quarterly subscription, it's $9.95. You get a free 2-week trial. And if you cancel within the first 2 weeks, you don't get charged, but you get full access to everything in the meantime, which is pretty cool. So up to you if you want to check it out. Okay. In Thinkorswim, you can use simple, exponential, or Wilders. Yeah, I don't necessarily have a preference. Oh, you do have to risk some time, sure. Okay, Will. But that's about it. You got to use up some of your time. But I believe it's good education, so thank you. It is great. Anyway, yeah, I can't remember which one I use in TOS. Am I open on TOS right now? No, I close it out. I usually use the default one, which I prefer exponential when it's possible to use. So anyway, getting back to these markets, the other thing that I'm very keen on following is the leading index. So for instance, one of the things I'll do here is create this kind of a chart. And let me remove these drawings. There we go. And I'll go to weekly chart again. What I've done is I've got a chart of the S&P futures. And actually, I need to update this to the Z contract because we're on the wrong contract there now. So change them all over. I probably could just use continuous contracts. That would be just as easy. And then that way I don't have to change it. But, if I want to be a little bit more exact in my analysis, then I use the specific contracts. So I've got the 4 major large, that's actually not even large, EMD. I've got the S&P, NASDAQ, Dow, and Russell, and then also EMD, which is mid-cap stocks. So I'm basically comparing the major indexes in the United States against each other. And one will typically emerge as kind of a leader in whichever trend we're in. So let's see, do I have them all switched to Z? Yes, there we go. So looking from the beginning of the year, 2023, there it is, zeroed out in January, you can see that the NASDAQ by far has been leading us to the upside. Typically, that leadership, when it gives up, whatever leader is pulling us higher, when it gives up, the rest of the markets are free to fall. They may want to go down, like the Dow has been lagging. It might want to go down, but it can't be falling when the rest of the markets are dragging it upwards. And same thing, if we've got a leader to the downside that's dragging everybody down, one of the markets that might want to rally can't do it until the others turn around. Well, you can see this summer what has happened with the NASDAQ. We're not bearish yet on the weekly basis, but we made a lower high. We just need to make a lower low to actually affect a change in the trend. And the NASDAQ has been kind of a leader for quite some time. Even if I go down to the daily time frame, you can see that as we're moving up, depending on where the study begins, we can just do the month of June here. Make sure. June 1st, there it is. So there's June 1st, and you can see as we were moving up initially, it was the Russell in green. That was the leader. You got the labels right here. And when that leadership gave up, markets turned around, and it looks like through July, I guess we were still being led. Let's see, from the beginning of the year, though, 2023, there we go. Again, it was the NASDAQ as the leader, but as soon as we got that lower high, and especially the lower low, now everything's free to fall. And that started in August. So now from August in that decline, who is leading us down? Well, it appears that the Russell is our leader to the downside. So same thing, we will continue to drop in value for these indexes until that leading index to the downside kind of gives up and allows everything to bounce. So you can actually start from wherever you want. I just did a calendar start from the beginning of the year, but honestly, the best way to do this kind of analysis is to start from a major high or low. So for instance, if I'm looking at the NASDAQ here, and I'm on a weekly chart, I could possibly use this low, which was December 27th, 2022. So not even the beginning of the year, or really we had a big bullish move begin right here in March of this year. So perhaps I start my study from that low where we started seeing the buying pressure that kicked us off. And we measure to see who is our leader there. And then it topped out, looks like July 17th. So March 13th to July 17th. Let's see. March. Oh, I'm on daily. Let's go to weekly. 22, 23. There it is. There it is, March of 2023. You can see from that rally, the NASDAQ was obviously the leader. And since then, now we are moving down, go down to a daily time frame, and our leader to the downside, as I said, is still the Russell, and it's still showing a lot of weakness. So, let's go back to that big rally that we were experiencing, right? From March of this year until July of this year, or August, really. Okay. As we're moving up, the Russell wasn't really participating too well. Neither was the mid caps and EMD. The S&P was okay, but again, the NASDAQ was the one that was really ripping to the upside. If we want to know where the top of the market's going to be, you wouldn't want to look at the Dow. The Dow's a laggard, and it probably wouldn't have told you much. If I go out to the Dow as an example, YMZ 2023 daily chart, and you go back, actually, let's do a continuous contract. It'll be a little bit easier to see. So YM continuous, clean that up. But again, going back to March right here, it's about March 13th was that low. And there we are, moving up in that upward trend. And you can see signs of weakness here, rallied up to a new high. There's not really any signal that we're going to turn around, right? And then all of a sudden here in August, now we're making lower highs and lower lows. As a matter of fact, the actual trend reversed right there, because that's where we finally made the lower low after a lower high. But there wasn't really any warning sign to tell you, hey, this is where we're going to turn. We're losing momentum. We're changing trend direction. We weren't even at I guess we were kind of near a supply area, but it had been tested. There wasn't anything really standing out there. That's because that was not the leader. The leader was the NASDAQ at the time. And by looking at the NASDAQ during that time, okay, again, we're looking at the reversal happening right about there. Started our move up from March, right there, 13th, okay? So now as we're moving up here in the NASDAQ, do we get warning signs? Well, first warning sign I'm going to look back for is supply and demand. Okay. And again, that's something I teach in the classes as well. I don't use traditional support and resistance. And the reason why is because supply and demand works better. That's pretty much it. I find that by following what I call supply and demand, I'm actually looking at the way the institutions trade and try to piggyback off them. And since they're the ones making all the big bucks, it makes sense to follow them. So, in the E-mini think tank, as I was saying, if you were to go to the members area, there are documents on it right there, base leg or legs based zoning technique, and even my charting routine, pre-trading routine. There's videos on it all. So I pretty much teach everything. Supply is equal to selling pressure. Demand is equal to buying pressure in a way, but it's not the same as support and resistance. So looking back here again, as we're moving up, this is an area of supply. We also have, actually, it was pretty close to this. Then we got another one. Yeah, it's not so clean, but perhaps up here. So what happened was prices were moving up in spring of this year, right there. And as we're coming closer to the peaks, potential peak, I should say, remember the leader to the upside, exactly, following the elephant. There you go. Yeah. So basically, we're following the big elephants through the jungle because it's easier than hacking our way through the jungle on our own with a machete. You just follow a path. And what's happening here is this is the leader to the upside. When that leader hits some sort of supply, it's where it's likely to turn down. And in addition to that, as we go forward here, you can see prices are making new highs. And we seem to be getting, well, not as much momentum as maybe we should. You can see that even though prices are rallying up very sharply, we're not getting that big of a jump in momentum. It is moving up, but it's not nearly as much as it should be. You see the angle of attack there, how big it is compared to this? So that's a warning sign that we're losing a little bit of momentum as well. Plus, we're now at an area of supply. Here we are again, and this is a little bit more critical. Right there. And it wasn't quite the same high. I thought it was about the same high, but you can see what happened to our momentum. We lost momentum at that area. So we're going a little bit higher again into the next supply zone. And one more time, it's kind of hard to see with all the lines in the way, but we bounce off the first supply zone. Now here we are again. You do, oops, there, get the lines out of the way. Once again, we're making a lower high. We're losing momentum. And right here is the first time we've actually made a lower low. And you look back in history of this chart, and there's no, maybe once in a while right there's a lower low. But now we've got lower high and lower low. So the trend has officially shifted and we hit supply. We did not get that warning sign on the Dow. We didn't get it on the S&P. We got it on the leading index. And prices started dropping. Well, they didn't go down very far. You can see we're basing right now. We're pretty much stuck sideways in a little bit of a range. But remember, the leader to the downside is now the Russell. So let's take a look and see what is the Russell telling us, right? Pretty much same pictures. We want to see which direction we're likely to go based on who's leading us in that direction. So the Russell on the weekly chart is really just consolidating. It's very, very weak. Making lower highs and higher lows. If you continue that out far enough, it's just going to make a triangle, right? So we're just getting sideways momentum. And you can see the momentum's died off. A little secret when it comes to the RSI, in a strong bullish trend, RSI doesn't go below 40. I mean, think about it, it makes sense because basically that RSI is measuring momentum. I said that, right? So RSI 50, that's neutral. If you get RSI above 50, that's bullish pressure. The further you go above 50, the more bullish pressure you have. If RSI is less than 50, that's bearish pressure. And the further down you go from 50, down towards zero, the more bearish pressure you have. Well, if you're in a strong bullish trend, you shouldn't see bearish pressure, or at least that much of it, right? It's just common sense. And in a strong bearish trend, just the opposite happens. So we'll stay below 60. Well, you can see that we're in a bullish trend right there, staying up above 60, not going below 40. Strong downtrend right there. What's happening? Just the opposite. We stopped going above 60 and we stayed below 40. Now where are we? In the middle. We're not really breaking 60 or going below 40. That means we're just going sideways. We're choppy. We have very little momentum. And if we go down to a daily chart, you probably even see it worse. Notice we're going above 60 and below 40. So we're really going almost nowhere. So we've got a very choppy sideways market. but we can start looking at smaller time frames just to get an idea of what might be coming up next week. If I'm looking at weekly charts, I'm trying to figure out a big picture what's happening, or even monthly charts. Again, you see that consolidation. We're stuck. Yeah, this is the Russell 2000. So looking at the daily chart right now, you can get ideas, before markets change direction like this. Right here, we were in an uptrend. Actually, we can go back before the uptrend began. Right there. If I ask you what trend we were in, looks kind of down, doesn't it? We're moving in overall downward direction. But that may be coming to an end. Why? Because prices were trying to make fresh lows. In order to continue trend, you need to see increased momentum, not decreased. If you get decreased momentum, that's a problem, right? And remember what I said about momentum before with this. That's missing. There it is. Oh, it's up here. Where are you? Get all back to where I could see it here. Right now, we are getting a downward move in price right here, and we're getting bearish pressure. But what you'll notice is, as we make a new low in price, we're not doing that on the indicator, are we? The indicator's, whoa, where are you going here? That hasn't happened to me before. Right there, you can see, as prices were trying to move down, we were doing it with less bearish momentum. That's not sustainable. When you make new lows, you should be making it with more momentum, not less, or even the same, right? You should be getting more bearish momentum if you're becoming more bearish in price. This is called a positive divergence. It's a warning sign of trend reversal. And sure enough, we started going up. And we got other divergences too. Notice we're in an uptrend. We're above 60, not going below 40. So very, very bullish. But as we're moving, you get these warning signs. Again, we're moving up. We should be getting more bullish momentum pushing us higher. There we have a divergence and prices come back down. Now it didn't reverse. There's a difference between a warning sign and a stall and a reversal of the trend. Okay, and again, I teach that in more detail in the E-mini think tank. But things like this, positive divergence, basically, price makes new lows, but with less bearish momentum. That's what that is, positive divergence, because you get a positive move, a bullish move out of that. Up here, we have a negative divergence. Basically, price makes new highs, but with less bullish momentum. And that's not sustainable. And price usually comes back down. That's exactly what happened there. But you got to have a confirmation for an actual reversal. This never got confirmation. So all we got was a pause right here on this pullback. And we keep going. So here we are going up again. And another warning sign. Right there. Price is trying to make a high without the momentum. And come back down. That was the beginning of August. So we did get a warning sign on the Russell as well as on the NASDAQ. And again, right now, the Russell is the leading index down. Therefore, we want to pay attention if something like this happens. Prices were trying to move down in August, but we were doing it with less momentum, right? And we just learned that that's a positive divergence and usually leads to a turn, and there's your turn. We had a nice big correction where we moved up to 1950, 1960 from 1860. It's a 100-point move. However, we didn't get a confirmation of trend reversal because we came back down and we're still going below 40. So where are we right now? Well, we are still in a bearish trend, but it's a weakened bearish trend. Since this is the leading index to the downside, it's telling me that we're not done moving down. We have the possibility of continuing to push downwards. Okay. Sorry, let's check this one out. Anyway, so that's what's going on right there. And this is on the daily chart. So again, we're peaking below 40. This is suggesting we're going to continue to push downwards in the markets. As a matter of fact, we have an impulse down, correction up. And it looks like it's stalling, not really at a fib level. Even if I use that, no, it didn't quite hit. I was kind of wondering if we were going to turn at a Fibonacci retracement level. Basically, we've already used up demand down here, so this should go down to our next level of demand. There's nothing really holding us up from getting down to this point. Oops, hang on a second. Check this out on my phone. Sorry about that. Oh, okay. So let's see, where was the other one that we just hit? Actually, it would have been this. It's been hit multiple times. You can see that we've worn out that zone. It should break through. And it's just a matter of time before we go down to the next level, which is 1814. We fix that. There we go. Get the numbers on the right side again. So if we're looking for opportunities, I should be looking for selling opportunities. Since this is the leading market to the downside, it's probably one of the better opportunities for shorting. And if I'm looking to enter somewhere, let's see if we ever, yeah, we can take a look at SPX and NASDAQ as well. You can see we retraced all the way back 50%. I'm not sure if there's still going to be more. Should be some opportunities there. We'll see. Refresh, get rid of the old zone. There we go. Clean this up. I don't want to have too many lines on my charts, but it looks like I might have missed out on it today because, well, it's not necessarily the best shorting opportunity or supply, but we did have this little drop-based drop right there. As you can see, right into that area, we actually should get a little bit of a bounce here pretty soon. And the reason why is when we started our move down, we did it from above 60 right here. Normally, that means that before you can make a fresh low, you'll get a bounce. So if you missed out on the initial opportunity to go short, don't fret because there will be another one. We're going to pull back at some point soon, or at least pause before we continue down. So again, if I go down a smaller time frame here, see if I can figure out where that's going to be for that shorting opportunity. And it might just be right there. I mean, do that, removed all the drawings. That's okay. Yep, that's it. Bear with me a moment. There we go. So on the Russell right now, we're looking at about 1886.5 to 1889.8 as a possible re-entry or re-engagement for the downward trend. And you can see we're starting to slow down the momentum a little bit right now, aren't we? And the reason why is on the bigger picture, we saw weakening of the downward trend. Actually, let's go to the actual contract to be much more accurate. There we go. That's better. So again, I'm going to start off on the weekly chart, just get a perspective of what's going on. And we don't really have anything to hold us up, although we are near kind of weekly demand right here. Rally base, not a great demand zone though. Go down to the daily time frame. And on the daily time frame, well, it doesn't appear here, unfortunately. Let me go back again. The continuous contract and write down my numbers for a moment. I have 1800 basically is where we're going right here. $17.75. Okay, so now I want to go to the specific. That's where you got to be careful of when it comes to markets. A lot of people, when it comes to charting, they'll actually use the specific contract, or the continuous contract. And if you use the continuous contract, sometimes you don't get very accurate numbers. So this is the area of demand that we were kind of looking at. It was 1814 to 1775. Here it's 1775 to 1801, or basically almost 1802. So that's kind of where I'm looking for the target. And as I said, the entry, well, we went down to a 4-hour. There wasn't really any quality areas for entry. This was a retest of a prior zone, but going down to 60-minute, just below the high right there would be a good entry spot. Let's see. Yep, that's included. So there's the possible trade opportunity for the leading market to the downside. And ultimately the target at 1801 or thereabouts. Do something like this. I'll call that target 2, and I'll show you why in a moment. I don't want to just let it run forever. I want to get some profits off the table when I can. And perhaps I lock in something like a 3-to-1 or 5-to-1 reward to risk. Let's see, text, top. There we are. A little bit better. And let's see, what do we got right now for risk? I'll just bring up a calculator. So we're looking at 1891.1 minus 1886.3. So 4.8, we'll say times 3. And let's see, 1886.3. I'll just write this down real quick, just in case if I forget. Okay. Looking about 1871.9. Close. Anyway, 1871.9 gives us 3-to-1 reward to risk for that first target. And that way we can book profits and just allow our winner to run since we already got paid. Makes it a little bit easier. So that's a possibility right now for what's going on in this Russell to the downside. And there's a couple of things I always want to pay attention to. Again, with momentum, I do not want to see lots of bullish momentum if I'm going short. So if the RSI is above 60, when I come up into that supply zone, I would pass on the trade opportunity. But this is RTYZ23 60-minute chart. And so keep an eye on that. I'm going to go ahead and take a picture of it for me. Oh, I've got it for later. And I'll set alerts as well on my trading platforms. Let's see, pictures. There we go. All right. So there we go. Now, yeah, we can take a look at this is the leader to the downside, but it doesn't mean we couldn't possibly look at other markets. We could definitely take a look at the NASDAQ as well as the S&P to see if there's other opportunities there as well. Right? So in doing that, bear with me a moment. Oops, what happened there? All right. Let's go out to, let's go to ES. Start off there. Pretty much the same picture, isn't it? You know, the weekly chart of the ES. How did I choose target 2? It was just above a demand zone. That was the daily demand on the Russell. You go to the daily chart here, and you can see there was that area of demand. It was actually better on the continuous contract, and that's how I chose target 2. I usually just pick an area above that. I don't want to get out at the zone. I want to get out before the zone hits, because if you wait until you're at the zone to get out, everybody else is also rushing out and you get caught up and get too bad slippage. So I definitely don't want that. All right. Bear with me a moment. Yeah, come on. There we go. Okay. So going back over to the ES, daily chart. Again, we've got this area that's all used up. You can see this is a little more bullish, isn't it? Take a look at the difference between the Russell and you have low, lower almost right here versus the ES, low, higher low, right? Totally different picture, isn't it? So you see there's a lot more bullishness here in the S&P, and that's why I was looking more for the short on the leading index. It's got a higher probability of making it down to the target. Meanwhile, the stronger or more bullish indexes are less likely to drop. And if it does drop, well, that's not even a good zone, to be honest with you. I was looking at this area here, but it's not a clean zone, so it may not work as well. We'll see. And again, we've had to move down. We got a retracement that's going on right now. Might still be in the retracement, but you see on the daily chart, we're stuck between 60 and 40 again. So the momentum is really just sideways. And if I go down to the 4 hour, see if we get any more detail here. All right. Okay. So here I am on the 4 hour, and there's a little more bullishness still. Notice we can't seem to get below 40, and we are going above 60. So this is definitely a bit more bullish than what we were seeing on the Russell. And that's a problem in looking for shorts. That's why I want to stay shorting markets that are more bearish, buy markets that are more bullish. Seasonally, this typically goes down this time of year, but in reality, we're not really seeing it. We're not seeing the reaction to the downside at all. So without that, we'll just have to, if I take it down to 60-minute, I think we have the exact same supply zone, but the probability of it working here is not as good. As a matter of fact, this doesn't even work as a zone because I have strict definitions as to what I consider to be a zone, and this one doesn't work. Reason why it doesn't work is you got, oh, wait, no, it does. I take it back. It does, I believe. I thought this was above the leg in, but this is my leg in candle. The low here, 57, 7.25. Yeah, it barely makes it. It does. Right there. Yep. So there is an area of supply, but as I was saying, this may not be as good of an opportunity to short because it's not as bearish as the Russell is. The Russell has a lot more bearish momentum and offers us a better opportunity, perhaps. And the same thing with the NASDAQ. When we go over to the NASDAQ, we get the weekly chart. Clean this up. Again, the weekly chart, we're still moving up, but we lost a lot of momentum. Remember, we saw the signals here first that trend is getting weak. Negative divergence. But this did not give us confirmation of trend reversal. And the reason why I say that is we went back up above 60 right here. So the fact that we made that peak above 60 kills the trend reversal. For us to reverse trend, we need to make lower highs and lower lows. Well, we got high, lower high, but we don't have the lower low yet. And the only way that'll happen is if we get enough bearish momentum to put us below 40 and break the prior low. So far, not happening. We're still somewhat bullish here. Going down to the daily chart, same thing like we saw in the S&P, we're making higher lows still. Even though we can't get above 60, that just means we're going sideways at this point. And this definitely does not look like a good shorting opportunity at all compared to what I saw on the Russell. Even on the 60-minute, yes, it has that same area up here. Drop. Base, 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 drop. But I wouldn't want to be touching this one necessarily. It may not even make it up to, well, it might make it up to the supply. It might even break it, actually. This is not as weak as the Russell. And that's why I was looking more for the Russell short than I was on anything else. It's just a matter of trading the leader and finding the best opportunities. And looking at all four of these together, even if you go down to that smaller time frame, say 60-minute. You can see on this move down today, and it's kind of a toss-up between the Russell and the NASDAQ intraday. But again, if you go to the daily time frame, the Russell is the weakest market since the beginning of August. There it is. And that's the one you want to be short on because it's the leader down. So that's kind of what I'm seeing right now in the markets as a whole. I'm looking for more shorting opportunities. I don't think we're crashing yet, but we are definitely seeing a lot of weakness, and it's being led by that Russell. So shorting opportunities there. If we were going to reverse, what I would look for first is on that Russell, some sort of divergence, perhaps, on the daily chart. See, we have a low here of 52.6, 54.1. That's a slightly higher low, which is good because we also made a slightly higher low on the indicator. So no divergence as of yet. That's not telling us we're bottoming out yet. So on the Russell, again, I'm still looking for that shorting opportunity. But if we do turn around or see some sort of reversal signal here on the Russell, I would actually jump over to the NASDAQ and look for a long, because that's the strongest index. And that's the one that's going to give you the biggest rally. But we just don't have any opportunities as of right now. Even all the way down the 60-minute time frame, you got supply, but no demand. So that's how I'm looking at the markets as of right now. I'm a cautious bear at this point, I suppose you could say, because I'm looking for that Russell to continue to push to the downside. The other interesting thing that this all leads into is another style of trading that I like to do. Just going all the way back here to our comparison chart once again. If you just took a look at the NASDAQ versus the Russell, see if I can do that. We'll do NQZ 2023. There we go. Get rid of all these others. Yeah, when we remove, hold on. Let me change that one. I'll do it this way. Get rid of it here. There we go. And now again, NQZ 2023. So now we're only looking at the NASDAQ and the Russell, right? And you can see that they changed direction quite a bit between leadership, right? We got the NASDAQ that's stronger, the Russell it's weaker. And going back to the beginning of the year, or actually March, again, remember it was March 13th, that was that low right there. And it was August 2nd that started the move down. So between March, that's a 0, there we go. Between March and August, we had a divergence between two related securities. I did Z, NQZ 23, right? Versus RTYZ 23. So what happened here is you see the Russell stayed down, the NASDAQ took off, right? It was the leader. They diverged. They're both indexes for the US equity markets. Granted, the Russell's for the small cap, while the NASDAQ is for the large cap. But what happens is you can actually trade one against the other. We call that spread trading. And that's a different style of trading that I do. Different program, but kind of cool. It's called Wealth with Spreads. Just going to show you that real quick. If I go back here, you can see I've got this. Where is it here? You may think, why am I not seeing it? Wealth of Spreads, there it is. And basically, I teach how to do that style of trading. Again, it's a little bit different because I'm trading two related securities rather than trading one security against the dollar, so to speak. I'm trading a security against a security. And what happens with that, in this case, I could actually trade those two against each other. So let me change my chart to that because, well, I'll just do it this way first. We'll go to a daily time frame, and I'm going to do NASDAQ versus the Russell. But you got to be careful because the Russell has a point value of $50 a point. The NASDAQ's only $20 a point. So I'm doing the NASDAQ times 20. That's called notional value. I don't know if you're aware, but there's actually two prices or two values, if you will, for the NASDAQ futures. Every future's like this. This is called the market value right now. The market value of the NASDAQ is what you see on the chart. So right now, NQ is roughly, was that 15,460? It's 462.50. I'm not going to get exact, but that's about the market value of the NASDAQ. Now, there's another value called the notional value. It's basically the value of what it is you're trading, the underlying security. And that's going to be the market value. I'll do it this way, equals times point value. So for the NASDAQ, that's $20 a point, right? Where's my calculator? 15,460 times $20. That means one contract is worth $309,200. That's the notional value of the NASDAQ, or one contract is worth that much. So when I'm trading the NASDAQ versus the Russell, I actually got to look at notional values. That way you're comparing apples to apples, not apples to oranges. So we just do that. Put in NQZ 2023 times $20 a point minus, and I have to do 2 Russell. So 2 times RTYZ 2023, and it's $50 a point. So basically what this chart is now showing me is the price difference between one NASDAQ minus 2 Russells. And that's the difference between them. That's it. Now, remember, if we go back to the beginning of this year, March 13th, they were pretty close to each other, weren't they? If we go back over here, where's it here? Right there. Back in March of this year, they were almost touching. And then they separated. So if we knew that the NASDAQ was likely to be the leader, we could have bought the NASDAQ and sold the Russell. Now, it's very difficult to understand that that's going to happen. But if we did, we'd buy NQ back here in March, and at the exact same time, sell RTY. How'd that work out? Well, the NASDAQ long, that made money, right? That would have made some profits. However, selling the Russell here, if you shorted that, you would have lost money. But, I'll do it this way. You probably would have lost less than you would have made, right? Because you see how fast that moved up compared to how slowly that moved up. So what's happening there, if you're trading the NASDAQ, I'm sorry, if you're trading the Qs, the futures are NQ. That's the NASDAQ 100 futures. The QQQ is the ETF for the NASDAQ 100. So anyway, you would have made money on one trade and lost money on the other. Net, you would have had a profit. And that's what we're seeing when we're trading spreads. We're trading the price difference between two related securities. So here you can see we went from, and this is just that one line. I'm going to get rid of the RSI for now. Right there, March of 2023, we had a value roughly of about 66,350. However, August 2nd is when you would have been exiting. And that value was $113,270. Since this is notional value, all you have to do is subtract the numbers, and that's your profit. How cool is that? So 113,270 minus 66,350 gives you a $46,000 profit. Isn't that amazing? Just by trading that spread. And the other cool thing about this is it's so much cheaper to trade it. Watch this. Where is it here? Trade Pro Trinity. That's what I want to open. That's why I love spreads. Some cool ideas and cool opportunities. Now, we could have also done the opposite. Okay, so first of all, let me write down, this would have been a profit of what? $46,000 roughly? We'll call it $47,000. And we'll see how much it would have cost us to do the trade. Because normally, if you want to trade the NASDAQ overnight, It's NQRTY spread. It's roughly 47,000. So normally, if you want to trade this NASDAQ overnight, you got to spend what, $18,000 in margin, right? It's not cheap. But when you do it as a spread, it's actually cheaper, a lot cheaper. I'll show you. Let's see. Where's my margin calculator? There it is. No. Come on. First, close that. And secondly, open that. So right here, if we're looking at margins, NQZ 23. But there we go. I'm going to delete this one for now. You can see that the margin, oh, actually, it's less now. Yeah, no, it's not. It's 18,480 in order to trade one NASDAQ contract overnight. However, if we do it as a spread with the Russell, we're going to do 2 on the short side here. And look at how much it is. So basically what we've done is 3 contracts. We're going to go short 2 Russell, long 1 NASDAQ, and overnight margins only 14 grand. That's cheaper than 1 NASDAQ contract. So if we take a look at the profit, which is roughly, whoops, wrong button. Profit was what, 46,920. Okay, 47,000. We divide it by 13,948. That's a 336% rate of return. That's pretty good, right? Pretty good opportunity there. So that's what I like about spreads. Now, this is where spreads become a little bit easier because remember, we watched originally that the NASDAQ took off compared to the Russell. And you don't know necessarily which one's going to take off. But now here we are in August and the trend's changing. And when trends change, usually relationships go back to where they were. So if we know that the NASDAQ is overvalued in relationship to the Russell, now we would do just the opposite. We would sell the NASDAQ short, and at the same time, you go long on the Russell. Now, here's the cool thing about this. Think about it. If both markets were to go up, nothing happens because you're long and short. You make just as much as you lose. If both markets collapse at the same pace, it doesn't matter. You're long one, short the other, you're neutral. You basically have gone delta neutral, meaning you've taken direction out of the play. So it doesn't matter which way the markets go. The only thing that hurts you is if they still continue to separate. But because they've separated so much and the trend is changing, there's a high probability they're going to come closer together. So if we sold the NASDAQ here on August 2nd and bought the Russell, where are we now? Well, let's take a look. Again, we're doing sell NASDAQ, buy Russell. And from that point, when you put them together there, see, I got it a little bit off. There it is. Buying the Russell, selling the NASDAQ. Well, this one's not working too well yet because, again, they're separating still to the downside, right? But eventually, if the NASDAQ starts collapsing and catches up with the Russell, this will be over some time. That's where you make your profits. And that is basically, in a nutshell, what a spread is. Trying to figure out when those are mispriced. And there's more tools that you use. But you can see right there, it actually started making some profits for a little bit. And then, unfortunately, went the wrong way. But now, since they're very separated, they've actually separated more than they have in quite some time. There could be an opportunity for it to come crashing back down and make profits on that spread. Let's say you just did it here. You know, you only did from that point to that point. That would have been 113,000. Oops, wrong one. Horizontal. So that was a $3,200 move from August 2nd to August 18th. That's still a good opportunity. And again, where it is right now, as a matter of fact, the way I trade these, I often use some extra tools like Bollinger Bands. You know, they're not guaranteed to work, but often when you hit that upper Bollinger Band, depending on whether or not you're overbought or oversold, as a matter of fact, right now we should be getting ready to turn down very quickly. And here's why. We have prices moving up to highs without the indicator doing that. Negative divergence, right? Near the upper band should send us down to the lower band. So if we shorted around 125,000, we should at least be able to get about $10,000 worth of move down to 115,000 before this movement's done. So anyway, that's another way of trading the markets, looking at it not just directionally, but non-directional spread trades. And those are two different programs I teach in the markets. We talked a little bit about how these markets have been working. Got any questions, let me know. I'd love to see you guys in some of these programs. I put out the link there. Again, if you're interested in the Wealth with Spreads program and learning more about how spreads work, it's this link right here. And if you're interested in joining me in just directional trading of these futures on a regular basis, then you want to click on that link, which is the E-mini think tank. So I want to thank everybody for being here for the Trading Coaches Corner this week. Kind of gave you some education on where I think the markets are going short term as well as a little bit longer. We're entering into a bearish time of the year until the Christmas rally. So for the next 2 months, I expect it to be a bit choppy. So make sure you know what you're doing or work with someone who can help guide you through this choppy market that we're going to be coming through. So thanks everybody for being here, and I'll talk to you again soon.